Welcome to today's deep dive. I am your host, and today we are looking at something pretty wild in the real estate market.
Yeah, thanks for having me. I am the resident analyst for this deep dive, and honestly, the Q1 2026 data we're looking at today is just staggering.
It really is. So to start off, I want you to imagine you're walking up to like the most exclusive, glamorous nightclub in town.
Okay, I'm picturing it.
You want to get in, you have the cash ready, but the bouncer stops you at the velvet rope. He says the cover charge is an extra 60% of whatever you were planning to spend inside.
Just to walk through the door.
Right, just to walk in.
And, well, you don't get that money back. It doesn't buy you drinks, doesn't get you a VIP table, it just evaporates.
Exactly. It is pure friction. But meanwhile, right next door, there's this unmarked speakeasy.
Right, the hidden spot.
Yeah. It might not look as flashy from the outside, but there is absolutely no cover charge. The drinks were actually paying you a return, and all the smartest, wealthiest people in the city are quietly slipping through that door.
We are basically watching a massive, fundamental rotation of wealth happening in real time. Capital is moving away from the velvet rope and straight into that speakeasy.
And that is the core mission of our deep dive today. We've been unpacking a huge stack of Q1 2026 institutional real estate reports and market briefings.
Yeah, and the numbers are just undeniable.
We want to answer one burning question.
Mm-hmm.
Why is the smart money in Singapore completely abandoning residential property?
Because they really are. They dumped an astonishing $7.9 billion into commercial and industrial spaces in the first quarter alone.
Right, 7.9 billion. And that massive surge allowed Singapore to surpass Tokyo for the first time since, what, 2021?
Yeah, 2021. So Singapore is now the absolute #1 commercial real estate market in the entire Asia-Pacific region.
Which is huge.
It is. And to put that into perspective, this isn't just a wave of unpredictable offshore capital inflating some temporary balloon.
With the locals, too, right?
Exactly. Large domestic institutional capital is moving at an incredible scale. I mean, look at CapitaLand investment.
Right, they had a massive announcement recently.
Yeah, they just secured a 2.4 billion Singapore dollar real estate mandate from income insurance.
Wow.
So when the biggest domestic insurers are handing over billions to be deployed directly into commercial real estate, it signals a permanent structural shift.
Okay, let's unpack this. The obvious question is why? Why is $7.9 billion suddenly surging into industrial parks and, like, mid-sized office buildings?
Instead of the luxury condos that Asian wealth is usually famous for.
Yeah, exactly. Why ignore the glamorous luxury market?
Well, it comes down to the severe friction of taxes and the magnetic pull of superior yields. Let's start with the friction.
ABSD.
Right. There is a 4-letter acronym reshaping the entire skyline of the city, and it's ABSD, the additional buyer's stamp duty.
Which is essentially a massive tax, right?
It is. It's the primary mechanism the government uses to moderate demand in the residential market.
And they've been raising it a lot lately.
Aggressively. Over the last few years, the rates have been hyped so high that it has completely altered how capital behaves.
So going back to our nightclub analogy, ABSD is that prohibitive cover charge to get into the residential investment club.
That's a perfect way to look at it.
Because if you are a foreign investor right now, you face a staggering 60% ABSD on any residential purchase.
60%. It's just massive.
Think about the gravity of that for a second. If you buy a home for $5 million, you
literally have to hand the government a $3 million tax check on top of the purchase price.
$3 million that you just never see again.
Exactly. But, it's not even just foreigners feeling the burn here.
Right. Locals pay it too.
Yeah, even Singapore citizens pay a 20% tax on their second residential property, and it jumps to 30% on their third.
It creates this concrete wall, a structural barrier to entry for anyone looking to build a residential investment portfolio.
But here is the ultimate loophole that is driving this entire $7.9 billion market shift, and it's hiding in plain sight.
Okay, lay it on us.
Commercial and industrial properties have exactly 0 ABSD.
Wait, none at all? Even for a foreign buyer?
0%. Across the board.
That's wild.
Yeah, whether you are a local citizen buying your first property, a foreign investor, or like a massive multinational corporate entity, the ABSD on a commercial building is 0.
Okay, so the tax avoidance is the initial trigger, but nobody buys an asset just because it isn't taxed.
Right, you still need to make money on it.
Exactly. They buy it for the return, and the yield gap detailed in these Q1 reports paints a pretty ridiculous picture.
It really does.
Right now, if you buy a prime residential property in the core central region, the gross yield is hovering around, what, 1.5 to 2.5%?
Yeah, around there, which is incredibly low, especially given the massive capital you need just to acquire the asset in the first place.
But conversely, if you look at strata industrial units, they're consistently generating 4 to 6% gross yields.
So you are looking at double, sometimes triple the cash flow of a luxury condo.
And without any of that residential tax burden.
Exactly. Zero ABSD, triple the yield.
But the momentum behind that industrial yield is what really caught my eye in the data. According to the sources, industrial rents in Singapore have grown for 22 consecutive quarters.
Yeah, 22 quarters straight, and prices just rose another 1.2% quarter on quarter.
Okay, but wait, I have to push back on this a bit.
Sure.
22 quarters of continuous rental growth. That sounds less like a solid fundamental and more like a terrifying bubble.
I get that.
Like, what is actually going on inside these concrete industrial buildings to justify that kind of relentless rent increase?
Well, if you just look at a chart, it totally looks like a bubble. But if you dig into the underlying economics, it's actually a structural shift.
A shift in what way?
It's the global economy manifesting in local real estate. You see, Singapore has a strictly finite amount of industrial land.
Right, it's a small island.
Exactly. The government heavily regulates how much acreage is allocated for factories versus housing. So you have a permanently fixed supply.
And against that fixed supply, demand is just going up.
Hyper demand, actually, mostly from three massive global sectors that simply cannot operate out of a standard warehouse.
Okay, what's the first one?
First, semiconductors and advanced manufacturing. Singapore is a major global hub for this.
Right, lots of tech fabrication here.
And these fabrication plants require incredibly high specification spaces. They need heavy floor loading capacities, massive power grid access, and, really high ceilings for automated robotics.
Oh, so they can't just rent a cheap tin shed on the outskirts of town.
No, not at all. They are deeply embedded in the specialized infrastructure.
Okay, that makes sense. What's the second driver?
The biomedical cluster. Areas like Biopolis and the Tuas Biomedical Park are expanding rapidly right now.
And what do they need specifically?
They need GMP compliant spaces to legally operate.
Wait, let's clarify that for the listener. GMP compliant. What does that actually mean for the physical building itself?
GMP stands for Good Manufacturing Practice. So in the context of real estate, it means the building has to support rigorous regulatory standards.
Like clean rooms and stuff.
Yeah, exactly. Specialized clean rooms, highly controlled air filtration and HVAC systems, vibration-controlled flooring, and secure waste disposal.
Wow, that sounds incredibly expensive to build.
It is. Upgrading a building to be GMP compliant takes immense capital. So once a biomedical firm finds a space that actually meets these global standards, they do not leave.
They just pay whatever the rent increase is.
Pretty much. They sign really long leases and absorb the rent increases because moving is simply too expensive and risky.
Okay, and you mentioned a third driver.
Yeah, the explosion of data centers and cold chain logistics.
Oh, right. Cloud computing is everywhere.
Exactly. And all of these industries are fighting over the exact same heavily constrained pool of high-spec industrial land.
So that 22-quarter streak is driven by real physical business needs, not just speculative trading.
Exactly. It's extreme scarcity meeting explosive demand.
That makes a lot of sense. So we have this macro environment of zero taxes and high yields. But to truly understand how this changes investor behavior on the ground, we need to move away from the abstract math.
Yeah, let's look at a real-world example.
The reports highlight a massive transaction that perfectly illustrates this capital rotation. Let's talk about the property of 402 Northbridge Road.
Oh, this is a phenomenal case study.
It's a 70 million Singapore dollar commercial building, sitting right in the Bras Basah and Bugis Heritage Corridor.
Right on the absolute fringe of the central business district.
But the crucial detail here isn't just the location. It's the tenure. The report makes a huge point about it being a 999-year leasehold property. Why does a 999-year lease matter so much compared to a standard 99-year lease?
It all comes down to lease decay and how banks view the asset over time.
Lease decay.
Yeah. With a standard 99-year residential or commercial lease, as the building ages past the 30 or 40-year mark, the value starts to mathematically drop.
Because the clock is ticking down to zero, right?
Exactly. When the clock hits zero, the land reverts back to the state. And when that happens, banks get very nervous.
They don't want to lend on a depreciating asset.
Right. They will enforce a haircut on your loan-to-value ratio.
Meaning, if the lease is ticking down, the bank literally won't lend you the standard 75% to buy it,
No, they might only lend you 50%.
which forces you to cough up way more of your own cash up front to secure the asset.
That is the exact mechanism. It severely restricts liquidity and makes it much harder to sell the property later.
But a 999-year lease removes that risk entirely.
Completely. In the context of Singapore real estate, 999 years is functionally equivalent to a freehold property.
Right, because you're looking at a millennium.
Yeah. It means the building holds full, undiluted, intergenerational transfer value. It's perfect for wealthy families looking to park capital for a century or more.
Here's where it gets really interesting. Let's do the actual math on this $70 million building for the listener, because this is where the sheer scale of the tax arbitrage becomes undeniable.
The math is pretty shocking.
Imagine a foreign family office wants to deploy 70 million Singapore dollars into the local market. If they stubbornly decide to buy a portfolio of luxury residential condos, they have to write a $42 million check directly to the government.
Just to cover that 60% ABSD cover charge.
Exactly.
It is a staggering destruction of upfront capital. $42 million evaporated before you even collect a single dollar of rent.
But if that same family office buys the 402 Northbridge Road commercial building for $70 million, that $42 million tax bill just vanishes.
It is completely wiped out. You get to deploy your full capital into the actual yielding asset.
But I have a question about this strategy.
Sure, go ahead.
Buyers aren't just sitting on these 1980s office blocks and collecting the existing rent, right?
No, definitely not.
The reports say they are gutting them, renovating them into boutique hotels, premium co-working spaces, or specialized medical suites.
That's the trend.
Isn't that massive renovation cost eating up the exact tax savings they just made by dodging the ABSD?
Well, what's fascinating here is that the margin for repositioning is massive right now. It is a calculated risk.
So they are spending heavily on renovations.
Yes, the renovation costs are heavy, but they are doing this to capitalize on an incredibly tight commercial leasing market.
Because office rents are going up.
Big time. The Q1 data shows that Grade A CBD office rents have just hit a 17-year high.
Wow.
We are looking at $12.04 per square foot, and the projections indicate they could grow another 5% by the end of 2026.
So the upside justifies the cost.
Absolutely. If you take a tired, underperforming building and spend $10 million upgrading it to capture those record-high Grade A rents, the overall capital appreciation far exceeds the renovation costs.
You have a tax-free entry, a permanently owned 999-year asset, and a macro environment that heavily rewards upgraded commercial spaces.
Exactly. It's a textbook wealth preservation strategy.
So a $70 million commercial block solves the tax problem and the yield problem. But what if an investor wants an asset that the government literally cannot replicate next year?
You're talking about absolute irreplaceability.
Right. What solves the preservation problem? This brings us to our second case study in the Q1 data, the Kitchener Road conservation shop houses.
Yes, the reports highlight a pair of adjoining freehold conservation shop houses currently listed for 28 million Singapore dollars.
Now, buying a conservation shop house in Singapore is essentially like owning a specific square on a monopoly board, where the rules explicitly state that nobody else is ever allowed to build a hotel.
That's a great way to put it.
You have an absolute monopoly on that exact footprint. The supply is completely locked.
That is the defining characteristic of this asset class. Absolute scarcity.
Unlike industrial space. Right.
Right. If you own an industrial space, the government can theoretically rezone a massive plot of land next year and flood the market with new factories.
Or a developer could just build a taller warehouse right next to yours.
Exactly. But the supply of conservation shop houses is permanently fixed by the Urban Redevelopment Authority, the URA.
They mapped it all out already.
Yeah. They have meticulously mapped out the heritage districts. They have designated the specific buildings for conservation, and that list is closed.
Closed as in no more additions.
None. Every single shop house sold is the last of its kind in that specific location. They will never build another one.
But if we look at the raw data, the yield on these shop houses isn't exactly through the roof.
No, it's pretty modest.
The gross yield on these Kitchener Road properties is roughly 3 to 5%. So on a $28 million asset, you are looking at roughly $840,000 to $1.4 million annually in rent.
which is decent.
It's decent, sure, but it's not the reliable 6% you might squeeze out of an industrial park. Why would the ultra-wealthy accept a lower yield for a much older building?
Because investors deploying $28 million into a heritage asset aren't really chasing the monthly yield.
They aren't.
No, the yield is just a mechanism to pay for the upkeep and the property taxes.
So what's the real goal?
The primary thesis here is capital appreciation driven by what we call zoning immunity.
Zoning immunity. How does that actually work in practice?
Because these shop houses are zoned commercial, they benefit from all the baseline advantages we've discussed.
Zero ABSD.
Exactly. They are entirely ABSD exempt, they are fully open to foreign buyers without restriction. But importantly, the URA conservation guidelines allow for highly flexible adaptive reuse.
Meaning you aren't locked into just one type of tenant.
Right.
So if the market changes, the building changes with it.
Precisely. You can lease the ground floor to a high-end Michelin star restaurant.
And the upper floors.
You can put an art gallery or a private wealth family office on the second floor, maybe a specialized aesthetic medical clinic on the third.
Wow, that is flexible.
This adaptability makes the asset incredibly resilient to economic shocks. If retail slows down in a recession, you pivot the space to boutique offices.
And if the office market softens because everyone is working remotely, you pivot to lifestyle, wellness, or F&B.
Exactly. That ultimate flexibility, combined with a permanently fixed supply, makes these shop houses the ultimate safe haven for preserving wealth across generations.
Okay, so the narrative here is incredibly clear. The smart money, the family offices, the institutional funds, they are staying right here in Singapore.
They definitely are.
They are dodging the residential tax wall, riding the industrial rental surge, and hoarding these irreplaceable heritage assets.
But the reports also spend significant time analyzing a massive countertrend.
Right, everyday investors.
Yeah, everyday investors who are feeling squeezed by local property prices. They often try to escape by looking across the border.
To Malaysia.
Yes, they look at residential condos in Malaysia. And if we connect this to the bigger picture, that leads to a deeply misunderstood financial trap.
The Malaysia condo mirage. We see this constant stream of local investors buying residential units in Johor Bahru or Kuala Lumpur.
Because the upfront price per square foot looks incredibly cheap compared to Singapore.
Honestly, if you are an average investor who simply cannot scrape together $28 million for a heritage shop house, a cheaper condo across the border seems like a no-brainer.
It feels like a brilliant wealth-building hack.
Right. So why is the data telling us this is actually a terrible move?
Because buyers only look at the sticker price, and they systematically fail to calculate the effective cost drag.
Effective cost drag.
Yeah. When you buy a foreign property, that cheap sticker price is just the entry ticket to a decade of financial bleeding.
Walk me through the math of this. Give me the actual mechanism. Let's say an everyday investor buys a $500,000 condo in Malaysia, expecting it to appreciate.
Okay, let's trace the lifespan of that investment.
How does the drag actually destroy their wealth?
First, you have higher mortgage interest rates for foreign properties and cross-border maintenance complexities.
Like property managers overcharging absentee landlords.
Exactly. But the real devastation comes from two specific factors: foreign exchange risk and Malaysia's real property gains tax, the RPGT.
Let's break those down. The foreign exchange risk first.
Imagine you buy that $500,000 condo in Kuala Lumpur. Over 5 years, the local property market does well, and the value of the condo goes up 10% in Malaysian ringgit.
Okay, so on paper, I'm feeling like a genius. I made a solid return.
You did, locally. But during those same 5 years, let's say the Malaysian ringgit depreciates 15% against the strong Singapore dollar.
Oh, no.
Right. When you finally sell the property and convert that money back to bring it home, your 10% gain is completely wiped out by the currency exchange.
So I've actually lost 5% of my original capital base.
Yes, the currency fluctuation silently eats the appreciation.
That's brutal. But what about the tax? Does Malaysia let you just take your money and leave?
Not at all. And this is where the trap snaps shut. When you sell, the Malaysian government applies the real property gains tax on your paper profit in the local currency.
Wait, on the paper profit?
Yes. For foreigners, the RBZT eats up 10 to 30% of any capital gains you make, depending on how long you have held the property.
Let me get this straight. So the Malaysian government taxes you on the 10% local gain, even though you are actively losing money once you convert it back to your home currency.
That is the brutal reality of the effective cost drag.
Wow.
You get taxed heavily on a local gain, you lose on the currency conversion, and you pay higher interest and maintenance fees the entire time you hold it.
So when you add all of this up,
The effective cost drag balloons to 30 to 50% over the lifetime of the investment.
that is insane.
Ultimately, chasing a seemingly cheap residential asset across the border can completely wipe out an investor's realized returns.
The cheap price tag is basically an illusion, hiding a massive structural liability.
Exactly.
So what does this all mean? If we look at everything we've pulled from the Q1 2026 data, the entire landscape of real estate investment in the region has fundamentally fractured.
It really has.
The old playbook of just buying a nice residential apartment, finding a decent tenant, and passively waiting 10 years for it to double in value is officially dead.
Completely killed by the 60% cover charge at the door.
Right. It has evolved into a highly strategic, almost weaponized game of capital allocation, even for the individual investor.
It's a game of total tax avoidance now.
Dodging that ABSD entirely by pivoting hard into commercial sectors,
And chasing relentless, structurally driven yield.
like riding that 22-quarter rental growth streak fueled by semiconductors and biomedical labs.
And finally, locking down absolute scarcity.
The 999-year commercial blocks that bypass lease decay, and those conservation shop houses that act as an impenetrable vault against new supply.
All of this data leaves us with a really critical reality to consider.
Yeah.
We have clearly established why institutional money, family offices, and savvy investors are hoarding commercial real estate and heritage shop houses.
Purely to avoid residential taxes and preserve their wealth.
Right. But what happens to the actual fabric of the city when its most creative, historic, and culturally significant spaces transition into pure financial instruments?
Oh, that's a profound point.
When a vibrant row of heritage shophouses spaces, originally meant for local businesses, grassroots retail, and community interaction, are bought up and held simply as quiet vaults for global capital preservation.
The character of the neighborhood inevitably changes.
Exactly. So how does a modern city balance the protection of its architectural heritage with the overwhelming reality of global capital flows seeking a safe haven?
That really is the multi-billion-dollar question, isn't it?
It is.
The smart money has clearly found the speakeasy with no cover charge. But if everyone crowds into the speakeasy, it eventually changes the entire neighborhood.
Couldn't have said it better myself.
Thank you for joining us on this deep dive. Keep questioning the headlines, keep looking at the underlying math, and we will see you next time.